Today, I'm going to talk about the outlook for inflation and growth, and I'm going to contrast the UK and US economies and break down what's driving inflation and growth in the two areas and what the differences are. If we're looking at inflation, you've really got to break it down into the two parts, which is manufactured goods and services. Manufactured goods is a global market, and the price of these manufactured items is set by global supply and demand. So a strong demand in an area like the UK, if other parts of the world are weak, doesn't mean that manufactured goods in general are likely to be expensive. The dominant factor in the manufacturing sector is Chinese capacity, where they have a huge amount of capacity after the investments they've made in the last 10 or 15 years. And this excess capacity is leading to lower pricing, disinflationary pressures, and that's something that's likely to continue for the medium term at least. So on the manufacturing side, the news on inflation is definitely good. The services side is a very different market, however. So it's really about the jobs market. The services is really jobs. And the jobs market is actually tight in places like the UK and the US because after COVID, a lot of people who stopped working decided not to return to the jobs market. So supply and demand is quite tight. And rather than being global, it's very much a national or regional market in terms of jobs. So inflation is still running at quite high levels in the services side. And that, again, is something that's likely to persist. So it does offset the manufactured goods side, and services is a much larger part of the economy. It's 60 to 70% of the economy is services, and 30 to 40 is manufactured goods. So overall services is more important. So if there is going to be an inflationary shock from here, it's very likely to come from the services sector. So those two things are very similar in the UK and the US. They've got quite similar drivers and structural issues driving inflation and growth. Where the differences come from is firstly in terms of what current growth is. So the US has significantly higher growth today, and I think this is mainly cyclical. So there are structural advantages the US has got, and it's had higher productivity growth over time. But the biggest difference today is government spending in the US, which is very pro-growth. They have large deficits, and this is leading to a really quite strong economy. But of course, these kind of factors do tend to even themselves out over time. So I think as an investor, I would be quite keen to sort of strip out that impact in terms of the long term. The other impact of the difference in the UK and the US is interest rate sensitivity in the economy. So if we look at the residential mortgage market in the US, people who own properties, almost all of them have very long-term fixed interest rate mortgages, 20, 30 years. And they lock those in. And most people who own properties locked in the generational lows in interest rates 2 to 3 years ago. And of course, they're not refinancing them now. So interest rate increases in the US are not being translated into higher mortgage costs in the US because people aren't changing the mortgages that they already have. The UK is very different. So most UK mortgages are effectively floating rate because either they are floating or they're on very short-term fixed deals. So every 2 to 3 years they refinance. So the translation of interest rates into constricting consumer spending is much more direct in the UK. Now, of course, everything is complex, but really for that reason, the UK is likely to have a much weaker economy in the next 6 to 12 months than the US. Now, you might think, well, this is going to be very bad for UK asset prices. And I would say, well, not so fast, because if you stand back and think, what are assets in places like the UK? Well, we've got bonds, where weaker economy should lead over time to lower interest rates, which of course is good for bonds and will mean higher bond prices in general. And we've got equities. UK equities, overwhelmingly, the FTSE 100 is a very global index. So a weaker UK economy does not translate necessarily into lower FTSE earnings and lower share prices. And the companies that are exposed to the domestic UK economy are, put simply, very cheap. So the expectations are really low. And really what's going to set the prices for those shares is what happens next. So it's more, despite the fact that the UK is likely to be weak, I think the outlook for UK asset prices is much more positive than that. As always today, I've been talking about investments, so you must remember that your capital is at risk. If you have any questions, please get in contact with me. I'd love to speak to you about that directly. And if you're watching this video for the first time and you don't subscribe, just please click on the flying colours icon and you will automatically be added to the list. Thank you.